the reason why you'd invest in a stock in the first place. So, how is money made with a stock? There are actually two main ways this happens. The first is through what we call capital gains. This term is not only used in the stock market, but also in the bond and real estate markets. Capital gains occurs whenever the price of the underlying stock increases in value from the original purchase price. For example, say Joe buys 10 shares in Boeing, which has a current stock price of $100 a share, for a total valuation of $1,000. 1 month later, Joe checks back on his investment and sees that Boeing's stock price is at $130 a share. So Joe decides to sell his shares. Since the stock price increased $30 or 30%, he made a $300 profit from it. That $300 profit is what we would call capital gain. The same thing would occur in the opposite scenario, except we will call that capital loss because Boeing's stock price would have plummeted. Something important to note is that the gain is not realized until the stock is sold. Like everything, when you incur capital gains, you have to pay what we call capital gains tax. This tax varies from country to country. In the United States, individuals as well as corporations are subject to capital gains taxes on their annual net capital gains. And obviously, if capital loss occurs, then you are exempt from the tax. The second way of making money in the stock market is through dividends. Dividends are a little harder to understand, so we'll start from a definition. A dividend is an amount of a company's profits that the company pays to people who own stock in the company. So a dividend occurs when a company distributes a portion of its earnings. This process is decided by its board of directors. The board will always use dividend distribution in times of profit in order to attract and keep investors. It can also be interpreted as a statement which says, "We are a strong company." The dividend is often called the DPS or dividend per share. It can also be quoted in terms of percentage, so dividend yield. In many cases, the more stable the company is, the more dividends it will offer in order to counteract its low price action movement. So basically, how much it moves up or down. On the other hand, a high growth company will rarely distribute dividends so the capital can be reinvested in the company to continue its high growth. Let's take an example. Say Joe is in search of another investment after a successful Boeing venture. A friend who's an investment banker gives him two picks, AT&T or Facebook. AT&T offers what we would call a fat 6% dividend yield, while Facebook doesn't offer anything. On the other hand, Facebook is projected to increase 30% in the coming year, while AT&T's projections say it will remain at the same price. Joe faces a tough decision. It seems as an obvious one, but when looking into it, it becomes harder. Facebook's projections say it will increase 30%, but those are only projections. Nothing is for sure. For all we know, Facebook could plummet another 30%. AT&T provides a solid 6% of the stock price as dividend. In this case, what is believed in the investment community is that an older person should invest in the more secure investment, while a younger person has the time to risk the capital and take the chance. Either way, both capital gains and dividends depend on the fortune of the company. Dividends as a result of the company's earnings, and capital gains on the investor demand for the stock. So this concludes the lecture of how money is made with the stock.